Welcome, everyone, to this afternoon's webinar. My name is Michelle Day-Harsh, and also with me is Deb Strong. Both of us are annuity sales managers here at Financial Brokerage. Today we have Regional Marketing Director Jay Aker with us, and he is going to be talking to us about their index annuity care product, how the product works, and some sales ideas that go along with it. So with that, I know we're starting about 2 minutes late. With that, Jay, I'm just going to hand it on over to you and let you get started.
All right, perfect. Thank you very much, Michelle. I appreciate that. I appreciate you guys hosting the webinar today, and for all of you that are in attendance, for taking time out of your busy day to join the webinar and learn about a new product that can definitely add sales. Notice I said add, not replace. So make sure that you pay attention and take notes, guys. I know that's hard to do on a webinar. I promise to do the best job I possibly can to keep you engaged. But try to keep a pen and paper handy, because for two reasons. One, you're going to have questions as I go through the webinar. Jot them down. We'll get to as many as we can at the end if we've got time. Number two, you're also going to think about one-liners, taglines, sales ideas, clients that are like, you know what, that could add to my business. This product, our entire portfolio, is not necessarily designed to replace any of the business you're currently doing. So the beauty of that is you have the ability with the current existing client base that you've got to go back with a plan. We're going to talk about a lot of different ways to do that, but let's go ahead and just get started into the presentation, and try to stick with me as quick as much as you can, and I'll try to rein me in when possible. So we're not going to start by reading disclosures, but I did show them to you, so everybody on the call is a speed reader. You all got that, and away we go. Annuity statistics. There's a reason I bring this up, guys, and starting here, and I know you guys have seen some of this and everything else, but again, we're talking about a different product and we're talking about a different concept. We're not talking about the same webinar that you attend week in, week out, talking about here's how my income rider's better. All right? So I'm not coming in telling you mine's better because it's blue. I've got a new concept for you, but the statistics are important, and this whole thing about $2 trillion in deferred annuities, $61 billion in non-qualified annuities. Okay, this is a big number, and very important when you're talking about, okay, well, how relative is this opportunity with your product? Well, right there, $61 billion. And according to studies, and you guys know this, you're out there selling it, you've got the clients that have got these non-qualified annuities, and for many of them that aren't using it for income, it's a rainy day fund, right? So they've got some money in CDs, they may have some money in a non-qualified annuity, but it's a rainy day fund. And if you go to Annuity 101, why we sell annuities is because of the tax-deferred growth, right? It's one of the advantages. A lot of times it offers better interest rate than safe money alternatives like CDs, because even if the annuity is, or the fixed account on the annuity is only 1.6, well, if the CD, average 5-year CD, is only paying 0.8, that's a double the return they're currently getting. So you got to think in perspective of where clients have money. But the tax deferred growth, right? You know, waive the 1099, have less taxable income, put your money in deferred, but then we create this tax-deferred growth that whenever they decide to take it is going to be a taxable event, whether they take it for income, emergencies, care, pass it on. If they pass it on, then the kids have usually got to pay usually will pay, because we know when kids get lump sums of money, they're just going to take the lump sum and do with it what they want. They're going to pay taxes on the growth. So the reason we keep this in mind is again, the opportunities that are available for you. Now, when I started this, don't get me wrong, I've been in the annuity planning side of the world for 17 years. I helped market the very first income rider on a fixed indexed annuity. So I am a fan of income riders. The concern I have a lot of times is the reason they're so popular today is because of our low interest rate environment. Almost 80% of indexed annuities sold today are sold with an income rider attached that these people are paying a fee for, and hopefully it is part of their plan to trigger that income down the line. But they become popular. 80% are sold with these income riders because we're able to talk about 5% roll-ups, 6% roll-ups, doublers for different events. So these kind of Income Rider is honestly kind of the first hybrid option, in my opinion, for annuity products. Because if you go back to the day and the bad publicity of Allianz Life two-tiered products, a lot of people really look down on those products because they're like, oh, to get your money, you have to take an income. Well, people, that's what an Income Rider is. If you want the 6-7% and all these other bells and whistles, it only matters if you take the income. If sold correctly, it is one of the most valuable products you have. So keeping that in mind, that if sold for the right reason, you always have the right product, you can find them. Pension Protection Act, in regards to annuities, if the annuity qualifies, can eliminate the tax consequence in those non-qualified annuities, okay? So we know why indexed annuities are so popular right now, but the one thing that a lot of them cannot talk about is this rule change to the Pension Protection Act. So as you see in this display, 50,000 cost base, 100,000 gain, you have a $150,000 non-qualified annuity that is not being used for income. If they take it out for rainy day fund, whatever, all of that $100,000 is taxable. If they transfer it to our index annuity care, and then they take that money out for care, then every dollar is 100% income tax free. So again, if I've lost you a little bit already, come back. If you could ask any one of your clients, I guess my first question would be to you as advisors, do you think you have clients with non-qualified annuities that are not being used for income? I'm hoping everybody would say yes, or at least be open to asking the question. Because if you do, and your client says, well, yeah, I've got this non-qualified annuity over here with $150,000, but it's my rainy day fund. Have them explain what rainy day means. A lot of times it's not a roof or a car or a tire, it's I need care. I go into a facility, someone has to come to my house. To say, look, if I could eliminate 100% of the tax burden on all of that growth and ensure the rest of our income plan, is that something that you would be willing to sit down and talk to me about? Because think about it, guys. Again, like I said, the income riders are incredibly valuable tools in our low interest rate environment, but they're designed to pay for the fixed and discretionary expenses, right? When people say, look, I need to get to $90,000 a year to maintain my standard of living in retirement. Okay, how much do you have to accumulate based on the calculations? Here's what you got to have. Here's the best rider. But if you ask people, hey, what is the number one cancer for this income plan? What is going to eat this income plan up from the inside out? It's a care need. It is a major life event like that that's going to eat that up. And if I could tell the client, look, with your rainy day fund over here that's taxable if you use it and it's only worth $150,000, and then after the taxes on the $100,000, if I can show you a way to eliminate 100% of the tax burden on the $100,000 and potentially create you a tax-free lifetime payment to protect the rest of our income plan for you or your spouse, whichever one is healthy, if the other one needs a care, is that a good plan? I don't know too many people that are not going to look at waiving or finding a way around paying taxes on $100,000 of tax-deferred growth. It gets you in the conversation. So we've talked about this before.
I'm sorry, Jay, this is Deb Strong. I just wanted to bring something up on that last slide. You know, at Financial Brokerage, I get asked this same question probably 42 times a week from agents that say, hey, Deb, can you send me some leads? Do you have any leads? Well, I think the best leads that all of the agents have out there and financial advisors is their existing database of clients that they've perhaps been working with for the last 20, 30 years. This is a great way to come back to clients and add value, to go back and see if they have any old non-qualified annuities that were written with XYZ carrier that are simply underperforming. They've used up their, there's so much better reason for them to transfer this and have that tax-free income if it's not doing what it should have been doing in the first place. So I just wanted to add that to make people realize they've got leads.
their own clients. And if they aren't talking about this, then they're missing an opportunity.
Well, and thanks for jumping in. I'm hoping I'm getting you riled up is the reason you're jumping in there. So it is.
I'm all fired up.
Your existing clients are absolutely, and guys, and notice I didn't say go in and write something else other than what you're currently selling, right? This is going to add to your bottom line. If you're trying to find a way to grow your business, which I'm hoping everybody does, but if you even just sent out, so again, if you're drifting, come back. If you even just sent out a letter to all of your clients saying, hey, do you happen to have any non-qualified annuities that you're not using for income? If so, there has been a new law passed that could potentially eliminate 100% of the tax burden on all the tax-deferred growth on those non-qualified annuities that you're not using for income. If this pertains to you, call my office right now. And if you send that out to every one of your clients, $61 billion in non-qualified annuities that are going to end up at the hands of a beneficiary, you're going to make a new sale. And here's the thing, guys. This is the beauty. I don't want to go too far with this, but a lot of times when we do our annual reviews with clients or they call us and it's like, oh, well, you've got this annuity over here, but it's still got 3 years before it's out of surrender, so we can't do anything with it. If I'm eliminating 100% of the tax burden, I'm creating a tax-free income, and I can potentially make that income go for life. Do you think in my suitability department that I care that there is a few years left of surrender? And here's the other part. We do not have a hard line in the sand suitability-wise on that topic. If it makes sense financially, and you can tell me why it makes sense financially, then there is a good chance we're going to issue it even if there is a little bit of surrender charge left. So if you've been waiting 2-3 years or you got a ticker on your calendar to call somebody back because you're waiting for it to get out of surrender, call them today. All right, so when we get into this, whether you're looking at the non-qualified annuity or money that's sitting in CDs, see, that's the other rainy day fund part of this, that they have this $100,000. The whole concept is moving money from your left pocket to your right pocket and saying, would you rather have $100,000 if you needed care, passed away, or changed your mind, or would you rather have $200,000 for care? Would you rather have $300,000 for care? Would you rather have $900,000 for care? Now, the reason I say $900,000 is because you cannot put a quantity, I cannot quantify unlimited. A lot of people, you say unlimited and the wheels, it just kind of goes blank, but throw a number at it. You want to leverage just $200,000, $300,000, or $900,000? And you guys tell me. Again, the reason income riders are so popular is because of the leveraging it gets you on the calculation to receive a higher income. It's all about leveraging. You tell me what income rider on the planet that you can say, look, if you give me $100,000, I can promise you to leverage it to $300,000. Is there an income rider out there that can do that? And oh, by the way, if it's a non-qualified annuity or cash, however it's coming in here, it's 100% tax-free when it's used for care. It's all about the leveraging. So when we look at the product, guys, and an indexed annuity is, if you haven't sold them, it is a fixed product. All of the bells and whistles of the product are no different than a traditional fixed annuity. The only difference is how interest is credited to the policy. Okay, that's it. That's the only difference. Everything else works exactly the same. Sometimes people try to overcomplicate it because it says index. The only thing that changes is how interest is credited. So we look at the S&P 500. It's a 9-year product, so all of this kind of falls in line with the typical index annuity that's out there on the market today. Now, you can put qualified money into this policy. Always remember, if I've lost you, come back, wake up, put the phone down. The Pension Protection Act only pertains to non-qualified money, non-qualified annuities, okay? So if you have qualified money and you want to put it into this particular plan, you can, but then when the money comes out, even for care, until the account value is driven to zero, it is going to be a taxable payment until you get into the rider, which we're going to talk about in a second. So qualified money can be used, but Uncle Sam on qualified, he's always going to get his. So the Pension Protection Act only applies to the non-qualified money that can go into this policy. So here's an example. Let's say this is our client's assets in regards to rainy day money. They got $500,000 in non-qualified annuities. They got a bunch of money in CDs spread around that we want to split this money up. Okay, so we transfer $135,000 non-qualified annuity to the base policy, and then we add, and I call it the income protection rider, because when you're selling indexed annuities, almost everybody says, yeah, I've got an indexed annuity with an income rider. It's a majority of what people talk about. Again, 80% of them are sold with it. So if you use the terminology that's similar, this is an indexed annuity with an income protection rider. This is your insurance for your income plan, okay? So we put a rider on here. This is added a lifetime benefit. And again, you can put a husband and wife on here, guys. This is a joint policy. So I can add a spouse. On the annuity side, it has to be a spouse. But I can cover 2 lives with this. And I can add a lifetime benefit. So I have, just like an index annuity with an income rider that offers a lifetime income, I can add a rider to mine that gives you a lifetime income, 100% tax-free for care for you and your spouse. And there's no reduction.
When they do that COCR rider and they get that additional protection for lifetime, am I correct in saying that the agent's going to get comped on those premiums as well for 10 years?
Yes, you're absolutely right. So on the rider, it is awesome. The rider can be paid for in a lump sum. So you see there where the $78,150, you could pay it in one sum out of cash, and you would earn street level is an 8% commission on that $78,150. The base policy, the $135,000 street level, 6.5%. So you get 6.5 on the 135, you get 8 on the 78,150. Now, if you do a 10-pay, 20-pay, life pay to pay for the rider instead of a lump sum, so you've got options, you would receive that 8% comp for the first 10 years on the rider. So you are creating, if you're a variable guy, you're creating a 10-year trail. If you're a life guy, you're creating a renewal commission. However you want to look at it, but you can make comp on this if you're clients making payments over 10 years and creating, again, a lifetime benefit. And I don't think there's any income riders out there that are paying comp for adding the income rider. So thanks for bringing that up. Sure. Everybody likes to get paid. So what we did is look at this scenario, and just like every other indexed annuity, you know, it's past performance, blah, 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 disclosures are not indicative of future returns and all that fun stuff. Hypothetically, and when you run an illustration, because you can run an illustration on this, we are going to show you the worst 10, the best 10, the most recent 10, and everything else to look at performance. So in this particular illustration, we looked at the last 20 years with a 25% participation rate. So, and we'll go through some of the strategies here in a second. But that 135 after 20 years grew to 253. We added inflation to the rider, so that monthly payment went from 45 to 66 over that 20 years. Okay, so the income is an increasing income because it's got inflation. The base policy grew, so even what you illustrated in the beginning, because the first payment that comes out is from your policy, that actually has built-in inflation, and I'll show you how here in a second. On this with the income protection rider, how I look at it is there's a multiplier, and I think there's income riders out there right now that once your money accumulates to a certain level, if you use it for income, you can add a certain multiplier bonus, whatever. There's all sorts of fun bells and whistles. So we do the same thing and give you the greater of the two. So you can see there's an account value multiplier and a single premium multiplier. So basically there's the guarantee side, just like every indexed annuity out there. If you have no returns ever, your multiplier is higher. So look, if we go to year 20, if you have no returns whatsoever, we're going to take your initial premium times 1.5, and that's going to be your long-term care benefit. And then whatever your rider has gone to, if you've added inflation, if the accumulated value is higher, so you've had some gains, which over 20 years, if we don't, we have some major, major problems, it's a multiplier of 1.15. So here's what that looks like. Is if your cash value, that last example with $135,000 deposit, keep in mind again, guys, here, flashback, stick with me, from that 135 I put in that's now 253, there's a lot of tax-deferred growth there that is going to come out 100% tax-free for care. I heard somebody say at one time, this is the one four-letter F word that you can use that people like to hear, free, okay? Use for care, 100% tax-free. And with the multiplier, $253 is actually worth $290,000 for care, which is substantially greater than the original 135 at a 1.5 multiplier. But even if in 20 years, guys, we didn't have any returns, think about other opportunity or other options or other places people are looking. If their 135 has no growth for 20 years, do they have $202,000 to use for what it was intended to do? The multiplier, even if you just sold the base policy and created a 24-month, a 2-year plan for care that was 100% tax-free and didn't even buy the rider, you've got an incredible opportunity to provide a great option of tax-free benefits for your clients. So what this looks like is you would take the base policy, and this is a joint deal, so it's taking it over 30. Okay, so if you are a single, we draw down the account value over 24 months. If it's a joint, husband and wife, we draw down the accumulated value over 30 months. Now, when I say that, people always get a little riled up, and they're like, oh, you're dwindling their account value. What does an income rider do? The income rider is nothing more than a paper calculation to determine how fast I'm going to pull the money from the account value. So even with all the lifetime income riders that are out there, they dwindle your account value first before you ever get into the insurance company's pocket. And if you think about it, mine, if you need care, can be dwindled down as fast as 24 months, 2 years for care, where all of a sudden you're in my back pocket on a tax-free basis. In this example, you've grown to $6,600 a month, and that covers you and your wife. If it's a joint, that's $6,000 for him, $6,000 for her, for a total of $12,000. So the benefits that can be given to your clients on this particular policy are just ridiculous in my mind, and it's just a matter of getting people to talk about it. So looking at it as a built-in inflation with the index, it's the same story, upside potential, no downside risk. So the fact that account value can grow to where I can pull out more when I need it over that first 24 months before I get in the rider. And the leveraging part of it, guys, is to tell a client, look, if you give me $100,000, you transfer $100,000, do you want it to be worth $200,000, $300,000, or $900,000, 100% tax-free should you need care? How do you want to leverage it? Okay, that's how you sell income riders. Do you want a 5% roll-up of 7 with this or that or the other? It's the same thing. Mine's just a little easier by saying $100,000 to get 2, 3, or lifetime. So here's the one thing where the red flag. So if, again, stay with me here because I want you to understand how simple this is. They're like, oh, geez, it's got underwriting. Okay, I ask this question every time I do this presentation because I've been in the annuity side for 17 years. I want you to think about 10 years ago, how many questions was suitability? And I want you to go to the last annuity case you wrote, how many pages is annuity suitability? Okay, you're doing underwriting. You're doing financial underwriting. And there are some hard lines in the sand where annuities are getting declined left and right because a carrier is saying that it is not a suitable sale for your client based on how you filled out a suitability form. You are doing underwriting. The underwriting on mine is easier than suitability. Okay, there are a few knockout questions. If you bought just the index annuity, there's a few knockout questions that basically say, can you perform all 6 activities of daily living? And then you get the policy. We have a 98% placement ratio. I bet you there's annuity companies right now, but suitability can't say in the last 60 days they've had a 90% placement ratio. If they want to create a lifetime benefit, the only thing we add to that is a 15-minute phone interview for cognitive. There's no blood, there's no paramed, there's no exams. Here's a few knockout questions to get the base policy. If you would like this to last the rest of your life for you and your spouse, let's take a 15-minute phone interview. So again, if I lost you, if you were in and out, if you're multitasking, come back, at least write down this website, indexedannuitycare.com. You'll find the rates, producer guide, all of the information that's out there, and you can definitely get a hold of the people there at Financial Brokerage to run illustrations for you so you can see some numbers. So indexedannuitycare.com. Now, before I leave this presentation, and I know I'm running, well, I'm not quite out of time yet. In the indexed annuity space, in the annuity space in general, there are carriers out there that will not allow for partial 1035 exchanges. So, unfortunately, what happens is people have to walk away from a sale because a carrier didn't allow for a partial and the client didn't want to move the whole amount. OneAmerica has recognized the fault in that and said, look, here's what we'll do. We've created what we call our transfer annuity. So you can send in, transfer the money, the entire amount, to OneAmerica. We will then 1035 whatever amount you want into your indexed annuity care. And oh, by the way, you can do this with all of our other products, but we're talking indexed annuity care today, so let's focus on that. On the annuity side, is you could transfer, let's say it's $200,000, you transfer the $200,000 to OneAmerica. We then 1035 the $100,000 to our index annuity care. So this is all tax-free exchanges. And then we hold on to that money until we get a 1035 exchange from wherever else you want the rest of that $100,000 to go. So this creates an additional selling opportunity. So guys, not only can you go through your files and find the non-qualified annuities that are not being used for income, you can go to all your files and say, who did I want to do something with, but they didn't want to move all of the money and the company didn't do a partial 1035 exchange. I can go back to them, provide them with a product that will protect and ensure the income plan I've created for them that's going to take care of their fixed and discretionary expenses. And I can also put them in a better situation possibly with a newer product by being able to use this transfer annuity with OneAmerica. So this is an incredible opportunity as well for you guys to be able to go after that kind of money. That is all I've got. Hopefully that at least gives you guys a couple of ideas of how you can add business to what you're already doing. If you're selling index products, hopefully you can see how it's similar to what you're already doing in regards to it being an indexed annuity with an account value and being able to add a rider that can create a lifetime income. Mine just happens to qualify for the fact that it could be tax-free for the rest of both of their lives if used for care. So with that, I will turn it back over to you, Michelle.
Hi, Jay. This is Deb again. And I just wanted to close with a few things that you mentioned today. And one of them is the fact that this is issued from 40 to 85. Not 40 to 80, but 40 to 85. So, because we get a lot of questions, what do you have for my client that's 82, 83? So now this is a great placement for that. And we mentioned going back to your existing client and talking to them about doing non-qualified, 1035 exchanges. And I'm thinking that's a great way for an agent and an advisor to retain their clients and provide so much value that when another agent comes in and perhaps tries to replace their business, they're going to call you as the agent and say, remember the value that you provided for them. And I can't help but think they're going to give you some excellent referrals from that. And then the other thing I was going to mention, and I'll close, one question.
Hang on.